Hi, my name is Alex Dumortier. I'm a Motley Fool contributor. If you've been following the market recently, you may have noticed that high dividend yield shares have performed poorly. We're going to look at a graph that shows the performance of 4 sectors that sport above market dividend yields relative to the S&P 500, beginning in the middle of the month of May. Those 4 sectors are telecoms, master limited partnerships, or MLPs, utilities, and real estate investment trusts, or REITs. Now, as you'll see from the graph, all 4 of those sectors are lagging the S&P 500, and some of them by a wide margin. And the same would be true if we were to go back at the start of the second quarter. So why is this happening? Well, let's take a step back. In response to the credit crisis, the Fed lowered the Fed funds rate to 0. That's its short-term policy rate, and it squeezed long-term rates through quantitative easing programs, whereby it was buying up bonds, so raising the prices of bonds and thereby lowering the yields. Those actions made both cash and bonds unattractive for investors. So as a result, income-seeking investors were forced to seek out alternatives to bonds and cash. And it's no coincidence that of the 4 sectors I mentioned earlier, those that are the most bond-like, MLPs and REITs, were also the best performers from the bear market low on March 9th, 2009 through the start date of the previous graph, March 15th of last month. Now, so those shares performed tremendously well for a long time, but we've started to see what looks like a reversal. Why is that happening now? The cause of that is we've started to hear rumblings out of the central bank, out of the Fed, that the Fed may curtail its quantitative easing program as early as this year, and this is earlier than the market had previously anticipated. Now, if bond yields normalize, the cycle I described earlier reverses. So as yields rise, income-producing shares lose some of their appeal relative to bonds, and this could be the beginning of what we're starting to witness now. Now, what does that mean for investors? Well, if you own shares in these sectors, there's no need to panic. If you bought these shares at reasonable valuations and you're a long-term investor, you can hold them through the cycle. There's no reason to start selling them now. But simply be aware that we could be entering a period that is going to be less favorable to those sectors. One sector I would like to highlight, however, a subsector of the REITs, are mortgage REITs, which invest in mortgage securities based on borrowed money. This is not a business model I like. I don't think there's a competitive advantage, and these shares have not performed well recently. I think this could be a warning sign and an opportunity to leave those shares behind. They've been tremendously successful. Investors have flocked to them, but I don't like the business, and I think investors should consider taking their money off the table in those securities. Thank you very much, and Fool on.